The one thing that has changed in the world in the past few years is we've moved from globalization to deglobalization. And guess what's happened? Inflation has moved up meaningfully. In fact, inflation today in pretty much every Western country is either at generational highs or even sometimes at all-time highs.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart. Many of the most important developments shaping events here in 2022 are happening outside of the US. Obviously, Russia's invasion of Ukraine has upended the geopolitical chessboard, as well as world trade and the energy and financial markets. And China, too, is making waves that all nations are feeling right now. What decisions these two world powers make, especially in terms of what kind of relationship they choose to have with the West going forward, will have large and long-lasting implications. To better understand the situation from a non-US perspective, we're fortunate to speak with Louis Gav, founding partner and CEO at Gavekal. Louis, it's a pleasure to have you on. Thanks so much for taking the time during your vacation there in the south of France to join us today.
Thanks for having me. Delighted to be here. Thanks a bunch.
Well, it's a real pleasure, and also props to your colleague there, David Hay, who was on this program a few weeks ago, who helped facilitate this introduction. All right, well, look, I've got a lot of great questions for you here. It's wonderful to have somebody with more of an ex-US perspective than the average expert on this program. Let me just start with a question I like to ask all the guests here at the beginning. What is your current assessment of the global economy and financial markets right now?
Man, how much time do you have? I could speak an hour to this.
As much as you got.
All right. Well, look, let's start with assessment of global markets. We're in a bear market for equities, and we've been in a bear market for bonds, which is unusual to get both at the same time, and I think speaks to the shift in the global macro environment, the structural shift away from a deflationary world to an inflationary world. So that I think the first realization, if you're an investor deploying your capital, is to know that you're in a bear market, and as long as you're in a bear market, making money is tough. I think Americans understand this well because your main sport is American football, and you have a defensive team or an offensive team. When you're in a bear market, you put the defensive team on the pitch and you're on the field, and you're just trying to not get scored on more than trying to put up points. So first things first, we're in a bear market, therefore you need to be defensive. The big question mark being, how can you be defensive when bonds no longer do the job that they used to do, because the macro environment itself has changed to an inflationary environment. And that brings me to the next point on the assessment on the global economy. And when you look at the global economy, you really have it's a very important question, because we've had the first down 20% on the bear market, and that's your typical bear market is down 20, 25. If you get a recession at the same time, then you're down 40. Then you move to what we call in our research an Ursus Magnus, like a really big bad bear. So the question of, we've had the first 20%, you've taken the hit on the chin. The question is there another 20 behind? And the answer to that will be, given by the economy. And I think as you look around the world, I struggle to see how Europe avoids a recession. Europe is already in a recession. China, for all intents and purposes, is as well. The combination of continued zero COVID policies plus this real estate slowdown is a tough 1-2 punch. And that leaves the US as a sort of, the big question mark as to whether you get the recession or not. I think that's a tough one. There's good arguments on both sides, but can the US stay an island when
Mm-hmm.
the rest of the world is slowing down. With every day that passes, that perhaps seems less likely.
All right. Great answer. We're done. You covered it all.
Yeah. All right. Have a great day. And I'll see.
No, that was wonderful. All right. I got a ton of questions to build off of that. And first, for folks watching, as I mentioned in the intro, Louis was kind enough to join us from his vacation in Southern Europe, where he doesn't have the world's best internet connection here. I assume if you guys enjoy this interview with him, which I can already tell you're going to love it, given his first answer here, we'll invite him back on when he's back in the office and has a crystal clear connection as well. All right,
sorry
so
about that,
Louis,
guys.
I want to stay up at the macro level, but real quick, a slightly more granular question based on what you just said. I would say most of the people that I've interviewed here recently are now saying they find it extremely difficult, and that's the diplomatic ones. The other ones are saying, hey, it looks pretty probable that we're entering recession here if we're not already in one, talking about the States. I know you're still looking at the data, but what does your gut tell you right now in terms of probability wise? You don't have to give me a number, but maybe like a high likelihood, medium likelihood, low likelihood.
Look, I'm a natural born optimist, and I'm probably more optimistic on this particular topic than my colleague David Hay, who you had a few weeks ago. So I think the case for recession is a pretty simple one. You have rising interest rates, you have rising price of gas, you have a stretched consumer,
Rising cost of capital.
Rising cost of capital. You're already starting to see sort of anecdotal evidence of the U.S. consumer retrenching. You had Walmart's earnings yesterday, and Walmart, saying that the rising price of gas and rising price of energy is definitely, hitting some of their sales. And that's the for recession. What's the against recession camp? And here, you're going to laugh me out of the studio, but the against case is that it's different this time. And that's why I say you're going to laugh me out. It's different this time because, we've had so much monetary stimulus, so much fiscal stimulus in the past 2 years that it's a little bit like, the pig going through the python.
Yep.
All this stimulus that we've put in, it's going to take a while to be digested. And, combine that with, frankly, yes, asset prices are down for the past year, but if you take a sort of 3 to 4, 5 year moving average, asset prices are still way up.
Right.
So there's still a lot of sort of pent up. There's been a lot of at least paper wealth creation in the past 4 or 5 years. So much so that there's probably still enough there to have some decent demand. So all this to say, we may get the recession, we may get the 2 consecutive negative quarters of GDP, but it's not. I think it'll be a pretty shallow one. So the end result is I'm not fearful that the U.S. economy is about to fall off a cliff. And incidentally, I'm not too fearful that the Chinese economy is also about to fall off a cliff. I know the Chinese economy is slowing hard, but a lot of the slowdown has been sort of pushed by the government. The crackdown on real estate, which they're now backing off of. First point, and then second point is zero COVID, which I hope they're going to start backing off of, and they're starting to sound like they're backing off of. So if you take those 2 big economies, U.S., China, I think there's enough, still gas in the tank for both of these for the world economy to not run empty. The one place where things look very dire, very, very dire is Europe.
Yeah, and you're there right now.
And I'm there right now, and here my big fear is a pretty simple one, and perhaps I should have started off with this because that's actually is the single most important thing today. Is the world is facing an energy crisis, and economic activity at the end of the day is energy transformed. Now this energy crisis is centered in Europe. The U.S. or North America is energy self-sufficient, so America isn't really going to have energy problems. China isn't going to have energy problems because they've turned back to coal massively. Plus, they're buying cheap energy from Russia. So, China and the rest of Asia is going to be broadly fine. The big question mark is Europe. And here you get to a very simple question is, if Europe runs out of energy this winter, which seems highly likely, what happens to all the supply chains for Europe? Do we get another supply chain shock, as we've had, several for the past few years? COVID, Ukraine war, last summer's shutdown of industrial production in China because of lack of electricity. Do we get that in Europe in the winter? And if so, what does that do to global inflation? What does that do to European growth? So the real black hole in the world is not the US. I don't think it's China either. The real black hole really is Europe.
All right. So many different places I want to go. I'm going to earmark. No, it's great. I'm going to earmark to come back to your comments about thinking that this may be a shallow recession, at least in the US. But let's go into China and Europe, because that was where the majority of my questions lay here. Let's see. One I had here was based on a recent comment you made where you said you believe that China and Russia will be the winners of the current energy crisis. So let's stick on this energy theme for a second. First, to your question or your point, yeah, I mean, if Europe does quote unquote run out of energy this winter, that's what powers an economy, right? So obviously less energy, less economic output. And so your question you're raising, which is the right one, which is, okay, so how much impact is there going to be to the economy? And what's interesting is you can make an argument that it would be, deflationary or disinflationary because of the slowing growth. But at the same time, if it disrupts key supply chains, then that can give us that cost push inflation.
I think it's
in the system today.
I think it's much more inflationary.
Yeah.
So yes, you could say, well, Europe, moving off the consumption grid would be deflationary, but let's not kid ourselves that Europe has been a big source of growth and a big source of consumption for the world for the past 20 years. European growth has been lackluster for 2 decades now. Europe falling into recession, you're moving from plus 0.5% growth to -2 or -3. I don't think is going to be, of course, it's not great for global demand, don't get me wrong, but the supply chain dislocation factor for me is much more of a concern than a potential deflationary hit coming from Europe. The one way Europe could end up being deflationary is all of this would trigger a further collapse in the euro. I mean, the euro, if it's not in a free fall, it's starting to approach one. And if you run out of energy, then you move into full free fall, which incidentally would further fuel Europe's domestic inflation rates. So no, Europe, I think, is an extremely dangerous place to have capital deployed today.
Okay, so I got a question I want to tie this to, but first, what put on your bullish hat for Europe. Like, what could happen that would improve Europe's prospects from here? I mean, I guess maybe one of them would be kind of just a magical, truce that appears between them and Russia, and all of a sudden, they start getting a lot more cheaper energy. Is there any other development than that could make a more bullish case for Europe's prospects?
Well, look, Europe is facing an energy crisis. So anyway that gets resolved is positive. So what are the ways that Europe energy crisis gets resolved? Yes, one of them is somehow, Europe once again is able to get a bunch of cheap energy from Russia, either because the Putin government falls or because Europe decides, not committing economic suicide is actually more important to us than the Ukrainians, or whatever the reason, Europe will need this energy. There's another way actually that Europe could potentially get all this energy is Europe to do what China decided to do last summer and what India decided to do also last summer, and turn back to coal. Coal is by far the cheapest way to produce electricity by a long shot. But today, unfortunately, Europe has basically decided to fight a two-pronged war. Now, you would think that all the Germans who work at the European Commissions would know that fighting two front wars don't work.
You think they would have learned that lesson? Yeah, exactly.
You would think they'd know it by now, but obviously they don't. And Europe has decided to fight a war against Putin on the one hand, and a war against climate change on the other. That's at least one war too many. And as long as Europe continues to say we're fighting a two-front war, you cannot deploy capital there. Now, if Europe in the coming months says, you know what, we're no longer having to fight Russia, or we're no longer having to fight climate change, then you can start deploying capital there again. But until then, Europe is confronting a massive energy crisis. Okay, great. So just to summarize, your prospects, given the status quo or the outlook, is not good. And you'd basically, painting with a broad brush here, you wouldn't be deploying capital there until they decide to at least downshift to a one-front war. Exactly. Okay. And you made by the way, there's some indication of that. Germany is, reopening coal-based plants. They're starting to re-import coal from South Africa, re-import coal from Australia, which, of course, needless to say, is an ecological disaster, right? Bringing coal all the way from Australia, all the way, put it in ships and shipping it literally across the world, is about as ungreen as you could imagine. But that's the internal contradictions we now have to accept in Europe. Yeah, and I'm asking you to speculate here. You're not necessarily a European energy policy, specialist. I'm sure you've got some expertise and understanding it, though. But Germany is still continuing to decommission its nuclear plants. Do you potentially foresee them eventually reversing that decision, or is that a permanent fatality of their current, climate change war? It's a permanent fatality of having the Green Party as part of a ruling coalition in Germany. Okay, so you don't see that being reversed until this government falls. No, the Green Party in Germany has always been deeply anti-nuclear, which is odd, because if you're against climate change and if you're worried about carbon emissions, actually nuclear is the answer, not the enemy. But for the Green Party in Germany, nuclear has always been the enemy. So as long as the Green Party's in power, they're going to keep decommissioning the nuclear plants. It's nuts, but there you have it. Yeah. Okay. And we said there's been a lot of interest in the audience here of sort of learning more about the nuclear story. I think there's a number of people out there who still have a number of the reservations that sort of the average person of the populace has, but it may very well be based upon information that's either not accurate or no longer as true as it was because of new technologies and whatnot. And that's a bigger conversation. I don't want to delve into that too deeply with you here, because there's a ton of area in your other parts of your expertise I want to delve into first, but great to get your opinion on that. So the question, the macro question I'm trying to work my way up to here is, your firm looks at the macro environment in markets all over the world, not just the US. And the question I want to ask is, how much are geopolitics sort of impacting markets today and driving the action versus kind of their historical average? Sort of generally, are we in sort of a unique or relatively different period of time compared to, many of the past decades? But before you answer that, or in your journey to answering that, you made a great comment about weaponization of industry. You said that and I'm going to tie a number of different points together here, but you've mentioned how the U.S., or you've talked in the past on how the U.S. weaponized semiconductors versus China, and then it weaponized the financial system against Russia, and then Russia's response has been to weaponize the energy sector against the West. So if you can sort of tie those points together in your answer, that would be great if you can do it. Well, that was my answer. You took it away from me. No, I'm kidding. No, but to your point, I think historically, if you're an investor, you always faded geopolitical concerns. By and large, if markets sold off on a geopolitical event, it was an opportunity to buy it, to buy the market. It's geopolitics as a driver was seldom worked for more than a few trading sessions. I think indeed everything changed with, and I wrote a book about this, not to plug my book, but I wrote a book about this back in a few years ago called Clash of Empires. I think everything changed with the weaponization of the US semiconductor industry against China. If you recall, back in 2018, President Trump said, forget the trade war. We're moving into a tech war. We're basically going to tell every semiconductor company around the world that they're no longer allowed to sell semiconductors to Huawei and ZTE in China, unless then they lose the U.S. market. So you're going to have to choose, either you deal with the Chinese or you deal with us. And this was, a massive upending of the frankly, the global industrial order. It marked the genuine end of globalization. Because then if you're China, all of a sudden you have to build your own semiconductor industry. And you have to think, okay, the US is out to get me. How do I protect myself? I have a number of weaknesses. I'm vulnerable on the semiconductor front. I'm vulnerable on the energy front. I'm vulnerable on the agricultural front. Now, part of the end result of being vulnerable on the energy front is China gets a lot closer to Russia, because Russia can solve that for China. If China all of a sudden feels the US is out to get me, I have now to jump in bed with Russia. And even if Putin does unpleasant things, I'll just have to grin and bear it. And so, yes, we've seen since 2018, as you point out, you first have Trump, who weaponizes the semiconductor industry. And then indeed, following the Ukraine invasion, the Western world weaponizes its entire financial system against Russia. And, we confiscate the Russian central bank reserves. We confiscate the assets of every Russian oligarch in the Western world, be it, houses in Saint-Tropez or mega yachts or private jets or whatever else. We just take those. And Russia's response indeed is to weaponize energy, to say, well, Europe, if you're going to take my money, then I'm not going to sell you my gas anymore. What's the point of me selling you gas if when you give me euros, then those euros get confiscated? There's no point in me doing that. And so now all of a sudden, the end result of all this weaponization of everything is you end up with supply chain dislocations, such as we've seen in the auto industry and in the consumer electronic industry because of the weaponization of semiconductors. And that has an impact on markets and has an impact on prices, an impact on inflation, and an impact on corporate margins. And now we see the energy crisis in Europe. So we, had the supply chain crisis. Now we have the energy crisis, and the energy crisis is going to lead to another wave of supply chain dislocations. So yes, all of a sudden geopolitics matter, and they matter a whole lot. It's not something you can fade like you used to.
Okay, so if the game has sort of changed going forward, what do you think the biggest implications of this are going to be? So it sounds like you're saying, at least in the near to midterm, we're going to continue to have these inflationary supply chain disruptions. So I take it from that comment that you don't think disinflation is going to be all that big of a factor in the near term. So you're shaking your head as I'm saying this. Yeah. And how about just sort of like the balance of power going forward? Is China now on a much more tightened path with Russia here to work with the rest of the BRICS to try to become less dependent upon the West? You're nodding a little bit as I'm saying this, and I'm just tossing it out there as a potential one. So yeah. you tell me what you think.
Well, I think there's so many different avenues you can go down, but the first and most obvious one that we have to acknowledge is globalization is over, right? So we've lived through 20 years of globalization, and that globalization was profoundly disinflationary. Now, I think 3, 4, 5 years ago, the big debates I was having with a lot of clients and people were having everywhere was, what has been the key force behind the past 2 or 3 decades worth of what was then disinflation/deflation? Was it the demographic transition? Was it globalization? Was it technology? I think we now know. The answer is obvious. it was globalization, because we're still getting older. And
Yeah.
we still have technology. Like Microsoft and Amazon and Facebook didn't disappear. The one thing that has changed in the world in the past few years is we've moved from globalization to deglobalization. And guess what's happened? Inflation has moved up meaningfully. In fact, inflation today in pretty much every Western country is either at generational highs or even sometimes at all-time highs. Or at least at post-World War II highs. Now, which brings me to my next point. You alluded to, do we believe in disinflation or the rollover of inflation? I think when you look at the history, my friend Vincent Deluire of StoneX made this point recently on one of our podcasts, and he's made this point on many podcasts. And if your listeners don't follow Vincent Deluire on Twitter, they should. He's made a very good point, which is that inflation is inflationary. I.e., and just like deflation feeds on itself, which is why central banks try to cut it out before it really gets out of hand, inflation also tends to feed on itself. And so if you look at, and he's done this study where you look at all the episodes across major markets since World War II where inflation moved above 5%. And the point was, let's look at inflation above 5% and how many times did it roll over and go back below 2% within the following 2 years. The answer was without interest rates absolutely crushing the economy, without basically having to raise interest rates and having a massive recession. How many times, and out of 50 different times, it happened once. So 2%.
Okay.
And the more likely scenario is that the inflation keeps feeding on itself until you crush through massively high real rates, until you crush it through massive. So the end result is, why should we believe that inflation today is over when? Sorry about this.
That's all right.
Why should we believe that inflation is over when policymakers have yet to really tighten fiscal policy in any meaningful way, and have yet to tighten monetary policy in any meaningful way? And the answer is it doesn't. It's yeah.
All right. Let me just ask on the monetary policy tightening, just because it's so relevant or so timely. So the Fed is now tightening here in the States. I take it from your comment, you don't think it's tightened meaningfully enough yet. What do you think meaningful would be in the States in terms of a federal funds rate?
Well, here's the interesting thing. The Fed has been saying, look, I'm going to be tight, I'm going to crush this inflation, etc. How much has we've had inflation above 2%, which is the Fed's target rate, since March 2021. Right. That was the first time where it moved meaningfully above. In March 2021, I think I'm quoting from memory, but I think the reading was like 3.1 or 3.2. So it was, it was 50% above target. So March 2021. Since then, okay, they kept expanding the balance sheet from March 2021 till April 2022, right?
They kept putting fuel on the fire. Yeah.
They kept, from March 21 to 22, the Fed balance sheet kept increasing by anywhere from 30 to 80 billion a month. Since April 2022, so now 4 months, how much has the Fed balance sheet shrunk?
Oh yeah,
how much
not
is
at all. Not at all.
Like 5 billion, yeah. Like peanuts. Nothing. It's flat. So you had inflation accelerating. They kept adding. Now, we also know that monetary policy acts with a lag. It's like 18 months to 2 year lag. So today we have negative real rates of, pick your number, -5, -6%. We have a Fed balance sheet that is not shrinking, and that was expanding up until 4 months ago. It was still expanding. And we're in an energy crisis.
Yeah.
So why is inflation going to roll over?
Okay.
I mean, base effects, sure. You could tell me base effects, it's going to roll over because of base effects, etc. But again, inflation also has this nasty tendency of feeding on itself.
Right. Well, you
Prices
mentioned
go up. People ask for higher wages. So
right,
here you are
and
in
then
the
that's the
U.S.
fear of every central planner, right? Is that the consumer mindset changes where they really begin to lose faith in the purchasing power of the currency, so they start spending it faster because they fear if they wait, it's going to buy less, and that just feeds on it too, right?
Yep, and inflation feeds on itself. So look, the big question is, we've had for 20 years a disinflationary mindset. Do people still have that, or have things changed? And I think in that respect, the coming winter will be essential, because if we get more supply chain dislocations because of the unfolding energy crisis, then yes, we're screwed. Then the inflation isn't rolling over anytime soon.
Okay, and it just sounds like from the comment you're making that you believe that that supply chain disruptions of a certain extent, at least, will be present due to some energy shortages. I don't want to make it sound like you're predicting that Europeans are going to freeze in their homes over the winter, but it doesn't sound like you're very optimistic that they're going to avoid at least some continued energy issues, and you think that will continue to support the supply chain inflation that we're seeing.
So, last summer, there were energy shortages in China. You had massive energy shortages in China. And the way the government responded was to basically tell the steel mills to shut down, to tell the petrochemical plants to shut down, to tell the naval shipyards to shut down. So last summer, if you look at, for example, steel production in China, you see this massive collapse, and then it comes back again in the fall. But China ran out of energy last summer and reopened all the coal mines and turned back to coal as a result.
Right, and they got in a massive bidding war with other countries for those resources, right?
Those energy resources. Yep. And so fast forward to Europe. I don't think people will freeze to death in Europe this winter, because when push comes to shove, if you're a policymaker and you don't have energy, you tell the steel mill, okay, you're not getting any. And the petrochemical plant, you're not getting any. The consumer still gets it, because indeed, you're not going to let grandma freeze in the dark so that you can produce cars. Now, here's the big problem is Europe is actually, deeply integrated. The whole point of Europe was to be deeply integrated, so that if you're Volkswagen, you can produce, I don't know, I'm picking this out of thin air, but you can produce the gearbox in Slovakia and the brake pads in Poland and the tires in Spain, and you put it all together in a factory in Germany. But if you have just one country, if I think a car is 13,000 different pieces, right, and you're missing one, you've got an extremely heavy paperweight. You got an extremely heavy paperweight. It's and so you look at Europe with its 27 different countries, and very and a number of them in a very precarious energy situation. You are going to, I think this winter, you are going to have supply chain dislocations in Europe. And to think that this isn't going to impact production in Europe and from there the rest of the world, because Europe's a massive exporter of machine tools, massive exporter of cars, massive exporters of chemical products, of specialty steels, of lots of things. I think we're heading to a very likely another supply chain dislocation this winter.
Okay. Thank you. That's exactly the kind of I want to say guidance, but those are the types of insights a lot of the viewers are watching here, because they're trying to make decisions about what they think is most likely to come. All right, I want to get back to China for a second, then I want to get into sort of your overall market outlook. With China, your firm focuses a lot on Asia, and China obviously is a massive player there. I want you to comment on two things. One is, I think there's still a mindset that China is the ascendant power of the 21st century. And, if the West is declining, China's star is rising. I have heard from other people who know China well, that they say, like China's still got a lot of problems. And you just mentioned some your thoughts earlier that you think China actually, there may be some sort of short-term reasons to be optimistic about China as it begins to remove the lockdowns. It begins to sort of go through a recovery from what it's been through. But I'm curious if you could speak to just sort of your general thoughts on the ascendancy of China here going forward. Is it the massive growing superpower really coming into its own here, or does it have some serious structural issues that are going to keep it mired for the foreseeable future?
So it's actually really interesting. So for your viewers, I first moved to China in '94, and I went to university there, and then I set up my business in Hong Kong in 2001 with pretty much a dedicated focus to try to understand what was happening in China, because I was so fascinated by it. And China is a fascinating place, because of its scope, because of its history. Nobody else has 5,000 years of history, and an extremely strong culture, and a diaspora all over Asia and frankly all over the world that remains very attached to the cultural aspects of China. So it is a fascinating place. And one of the fascinating things, to your point, is that when foreigners look at China, they quickly come to one of two conclusions. The first is either China's going to take over the world, option one, or option two, China is about to implode, and it's all going to end up as an absolute disaster. And there's no middle ground for most people. It's sort of they either fall into one or the other category in a way that nobody looks at Brazil and thinks, oh, Brazil's going to take over the world, or Brazil is going to end up in an absolute collapse, or nobody looks at Russia that way, or China, perhaps because of its size and its scope, etc. But what I would stress is, for me, the more interesting question as an investor is not, is China going to take over the world? Maintaining China united and decently strong, as has been the case for the past 25, 30 years, is already a challenge enough. I think as investors, the only question we should ask ourselves is there money to be made there? Forget, are they going to take over the world? Forget, are they going to implode? Is there money to be made there? And the answer to that question is, what is China trying to achieve? What are China's policymakers trying to achieve? Are they really trying to achieve global domination? I don't believe that's their goal. And when you listen to them, that's not exactly what they're saying. What they're trying to achieve is different. It's not global domination. It's global independence. And this is really the goal of China. And this goal has been, it's the result, of course, of 100 years of exploitation, by the colonial powers at the end of the 19th century, the invasion by Japan, but it's fed by things like the banning from China of semiconductors. No other country today is banned. Well, Russia now, but before, China didn't invade anybody. So they're banned. Things like banning them from semiconductors feeds the paranoia that the Western world is out to get them, or at least the US is out to get them. So with that in mind, what is their main goal? It is independence. How do you achieve it? You achieve it by having a strong currency. By, China's biggest single weakness today is the fact that so much of its trade is still denominated in US dollars. That, to buy oil from Saudi Arabia, to buy coal from Indonesia, buy iron ore from Australia, it first needs to buy dollars. It first needs to earn dollars. And to earn these dollars, it needs to sell stuff to the US. And this is the big change that's just happened, because now with, Russia cut off from the US dollar world, all of a sudden China gets to buy all the commodities it needs from Russia in renminbi, because Russia can't trade in anything else. So we've just, for all the talk about how, China is the big enemy of the 21st century and we need to keep China in its box, etc. We, the Western world, have just delivered Russia on a platter to China, because now China can buy its oil in renminbi from China, can buy its natural gas in renminbi from Russia, can buy its iron ore in renminbi from Russia, can buy its coal in renminbi from Russia, which then allows it to turn to Australia, to turn to Indonesia, to turn to Saudi Arabia and say, hey, I love your stuff. It's great stuff. But if you want to sell it to me from now on, it has to be in renminbi. And just last week, BHP, the big Australian miner, did its first ever deal for iron ore in renminbi. That's not a coincidence. So it's a very long-winded answer.
You think that's a really significant milestone here?
I think it's a massive milestone. Just like Saudi Arabia 6 months ago or 4 or 5 months ago, coming out and saying, maybe I'm going to start selling oil in renminbi. Because what's happens now is you have China turn to Indonesia and say, you know what, Indonesia, I love your coal. Your coal is so much better quality. It's so much greater than this Russian crap that I'm buying by the trainload. But Russia, I get to pay for it in renminbi. So unless you accept renminbi, I'm going to keep buying from Russia.
Right.
So now you're Indonesia. What'd you do? So the end result is, I don't think you have to look at China in the view of they're trying to dominate the world. What they're trying to do is de-dollarize their economy. And from there, you can have one of two views. You can say they're going to succeed. They're going to succeed in de-dollarizing their economy. And this has big investment consequences for China and for the rest of Asia. Or they're going to fail. And if they fail, then their economy will remain a subservient economy to the US economy forever. Now, I think that was a debate worth having up until 4 or 5 months ago. In fact, this is a debate I had a couple times with online with my friend Mike Green of Real Vision, who I know you just interviewed. Mm-hmm. With Mike taking the other side, I always thought there's a good chance they'll succeed. Now, this Ukraine war has thrown a massive wrench into all of this. So it's a massive accelerator. Now, following this Ukraine war and the fact that Russia is in essence going to become a renminbi zone, I don't see how they're going to fail that bit. Because, I think that the genius of Richard Nixon and of US foreign policy over the past 40 years was to separate Russia from China, was to basically split them apart, because deep down they're each other's natural allies. Because everything that Russia produces, China needs,
right,
and everything that China produces, Russia needs. So deep down, they should be good friends. They should be good economic friends, but they were always sort of very wary of each other, and they didn't do a lot together. But now that we've decided to completely cast Russia out in the cold, China's here to pick up the pieces. So we've basically forced Russia into China's bed, and in so doing, China has basically dealt with one of its biggest weakness, which is its lack of commodities. Since Russia is so deep, deep in commodities, it's got so much. Throwing Russia into China's bed should have been the last thing we wanted to do. That's where we've ended up.
God, I got so many questions I want to ask you, just to keep pulling on this thread, and I'm going to have to resist mostly because I've got a bunch of other more specific questions for you. All right, it's going to be hard, but I'm going to do it.
Go for it.
Last question on this thread, though, which is, so in terms of, the key question that you started your answer with, which is, hey, let's not determine whether it's good or it's bad or whatever. Let's just talk if there's money to be made here. As you look at it through your lens, do you see, where do you see the biggest opportunities to generate attractive returns in this arc of these shifting trade lines here?
So, look, we're all the fruits of our own experiences.
Our interview with Louis will continue over in part 2, which will be released on this channel tomorrow as soon as we're finished editing it. To be notified when it comes out, subscribe to this channel if you haven't already by clicking on the subscribe button below, as well as the little bell icon right next to it. And be sure to hit the like button too while you're down there. But hang in there for one more moment, as I've got a new free resource for you viewers I think you'll be interested in. Remember those Cliff Notes summaries from high school, where they boiled down the most important key points of the book or chapter you were studying and put it into regular language that you could easily understand? For a while now, I've been thinking of creating a similar summary of key takeaways from the video interviews I do each week on Wealthion, kind of an Adam's notes, if you will. That way, you don't have to furiously take notes while listening. You can lean back and immerse yourself in the discussion, and then go check out my written notes afterwards. So I've taken a crack at doing that for this interview with Louis. If you want to check it out for free, just go to wealthion.com/adamsnotes and let me know what you think. If the feedback is positive enough, I'll do this when I can going forward for future interviews on this channel. Finally, if the challenging macro outlook Louis has detailed in this interview has you feeling a little vulnerable about the prospects for your wealth, then consider scheduling a free, no-strings-attached portfolio review by a financial advisor who can help manage your wealth, keeping in mind the trends and risks Louis has mentioned here. Just go to wealthion.com and we'll help set one up for you. Okay, I'll see you next in part 2 of our interview with Louis Gav.